Well, no doubt a lot of you are walking around with a bottle of antacids as we watch our 401ks dwindle in value. The market slide is particularly gut-wrenching for people who are close to retirement and counting on that money to live on. But there are ways to protect yourself and make money in this environment. Here to tell us how, Ed Butowski of Chapwood Capital Investments and Stanley Crouch, Chief Investment Officer at Aegis Capital. Stanley, first to you. You talk about something called the destitute millionaire. What do you mean by that?
Well, the destitute millionaire is the person that, in good faith, say 5 or 6 years ago, bought a very conservative laddered portfolio of income securities, CDs, treasuries, high-grade corporate bonds, with a 1 to 5 year maturity range and usually equal buckets. They were earning at that point anywhere from $40, $50, even up to $60,000. Now, if they employ that same strategy, significantly impacting. I mean, they're lucky if they get to 1%. So $1 million in principal, which was generating a reasonable income, is now generating something that is well below the poverty line.
$10,000 a year,
exactly,
which you can't live on. So what do you do?
Destitution. Well, you've got to find alternatives. You've got to find income alternatives, and you've got to find them quickly. And make sure, our biggest thing is that this is a credit crisis aftermath. We call it the continuing aftermath at Aegis. And what we see is that sustainability going forward is critical. We think there's been a lot of over-concentration in the idea of growth and, frankly, a misallocation of resources.
So if you want to be conservative, though, because you're in retirement, you don't want to lose your principal, but you want to make more than $10,000 a year if you got $1 million, what do you do?
Well, you buy a well-crafted portfolio of high dividend-paying equities. Now, I know that's a catch-all lately. We've been hearing that a lot. But the key is to make sure that you do your homework or have somebody competent do the homework. Low leverage, very high quality of balance sheet and income
Something
statement.
like Johnson & Johnson, for example?
Sustainable, yeah.
Okay.
Sustainable companies.
Ed Butowski, what is your strategy?
Yes. Well, my strategy is real simple. I mean, I agree with what Stanley's saying, but when someone retires today, on average, if they retire at 65, they're going to live, on average, 22 more years. And with inflation coming, you've got to basically check at the door buying fixed income for the next 10 years to try to live off of that. You need to have, as Stanley was saying, total return. You need to have growth and income, and you need to be able to measure the risk that's a part of that. And right now, a lot of people, you know, David, we know it very well. People are just running scared. And if you took a snapshot today of the current economic conditions, this would be one of the greatest buying opportunities. And we hear it over and over again, but you have very low interest rates. You have earnings that are coming in very strong. Stocks are 35% undervalued based on next year's earnings expectations. And you have people selling out.
Okay, so be specific, Ed. Where do I go? What do I buy?
Okay, well, right now, if you're in the 401k, let's just talk about that for a second. A couple things you do. Start to migrate out of your bond funds. A lot of people are holding on to bond funds. They shouldn't, because when interest rates rise, those will lose value. People also made a lot of money in small cap growth funds in their 401ks. Start to move out of those, because higher interest rates hurt those more than the big companies. And exactly what Stanley said, buy high dividend paying stocks. I would focus on utilities a little bit more than most people would be, because I'm a little more conservative in that way. But make sure you get dividends and total return. Those are the things I'd focus on. Now,
Stanley, you say that there's some bonds that are still worth getting, right?
Absolutely. And with all due respect to Ed, I will take issue with one thing. It's a common assumption that we're going to see inflation and higher interest rates. I'm not so sure that's going to happen that quickly, because if we're really in a compromised world economic situation where growth rates are slacked to zero to even perhaps negative
for a couple of years,
for a few years, it's very unlikely that we're going to see inflation. We may even see deflation.
So very quickly, we got to go. But, but what kind of bonds would you be looking at?
There's a terrific opportunity because of the general negative sentiment about municipals. But within municipal bonds, project finance bonds that are high quality, essential or near essential service that have their own payment sources. They're not tied to the government.
In a well-managed city, like Oklahoma City, for example, wants to build a bridge, so they issue a bond for it.
But it's more the well-managed project. There's very fine universities, hospital systems, things with large endowments that can sustain themselves even in bad times and make sure that that income, whether it be equities or bonds, is very sustainable and not subject to...
Terrific advice, guys. Stanley Crouch, Ed Butowski, thank you so much for coming in on this Friday night. Appreciate it, gentlemen.